In this video, I want to explain how I'm up a little under $38,000 in profit so far of the month of March with a about 4-to-1 average win to loss ratio with a 53% win rate. So I lost 7 trades and only won 8 trades, yet I'm still up a decent amount of profits for this month. So I want to talk about the strategy. I'm also going to show you live replaying data of the setups and why I took it and how I took it and my thought process around it. But the first thing I want to explain is the concept of successful trading, or how I trade and how I view the market. So the first thing is finding an edge or building a strategy that is repeatable. Something that you look for on a daily basis. I'm going to show you all these trades. I'm going to show you what I did right, what I did wrong. And what you're going to notice is on the trades that I win on are very similar to the trades that I lose on. There's no difference between winning or losing trades for me. I'm repeating the same setups over and over, bullish or bearish, it does not matter. Essentially, I look for the same things. Every single day, I look for buyers at my demand zones, buyers at my support levels, sellers at my supply zone, sellers at my resistance levels. And I'm defining opportunity the same way. And when I find that opportunity, I place a trade. And you also have to adapt to the current market conditions, because there are some setups that I lost on that I won on the day prior, but I didn't adapt to the market conditions on an intraday basis. And that was the result of having a losing trade following the same repeatable system. And if you do this, this is how you're going to be able to develop the confidence needed to navigate the markets. Like, I go in the markets every single day with confidence because I know what works for me and I know what to look for. That if I find that opportunity, I know the probabilities are going to be in my favor to put on a nice profitable trading setup. Now, flip this a little bit. Understanding repeatability, but also having solid risk management parameters. I am wrong sometimes. I make mistakes sometimes. But in order to protect myself against this, I must implement solid risk management, that even if I find these repeatable setups daily, I still take trades that lose, right? So yeah, you have the repeatability. Yeah, you have the confidence, but you still are going to lose. So the mechanism to protect myself and the mechanism that you need to implement to protect yourself is a solid risk management plan and solid risk management parameters. For example, this was a trade that I took on Friday, March 15th, and it was a $3,000 losing trade. And this setup was an excellent setup. It just simply did not work out on the entry that I got timing wise. And one thing I do want to say is every single trade that I've taken the past couple months all have been posted in the Discord, win or loss, for full transparency. So you can literally go back for the past couple months and see why I entered, where I exited, and what was my thought process for that setup. So on Friday, March 15th, I took a long position as the market was selling off. I was spotting buyers on the time and sales, and I was comfortable putting a 3-point risk on for about a 7 to 21 point reward, depending on where, if my first target did hit or not. So as you can see here, the market was aggressively selling off, and we then started to consolidate for a little while. And as the market dipped here around 10 o'clock, 10:01, I spotted to find some buyers on the tape. And that green arrow is my entry point where I was comfortable putting risk on long. Now, what I saw here at 10:02 was pulling up the heat map here, and I have tons of videos on this if you're new to my channel and you don't understand this. But the market was aggressively selling off. We can see a larger bid getting filled here at 9:45, and we kept breaking the low. And one thing that I love to do for reversals is gauging how the market reacts if it breaks a previous low or if it breaks a previous high. So in this example, you're going to see previous lows, right? One right here, one right here, one right here. And every single time the market breaks the previous low, it doesn't get met with aggressive selling. Now, this is a sign that, hey, either sellers are drying up, or B, there's a passive buyer entering the market. So what I saw here was at 10 o'clock, the market made a low. We dipped under this low. And then at 10:01, what I saw was, as we broke under this low, the market began to move up. And you see these red lines right here? These are bids on the order book. So as the market was breaking the low and failing to move low, it began to move up with aggressive buying, which are these green bubbles. As the market was moving higher, bids were appearing. We have a bid right here for 444 contracts. Got filled. Another bid appeared here as the market came up. 429 contracts. Got filled. So I was like, all right, Carmine, let's put risk on long right here at 5179, putting my stop loss under the low, targeting where all this aggressiveness here was at the 86s, and then the high of day at the 5200s. So right then and there, I was like, all right, let me try it long. 3 minutes later, the market broke the low, and I stopped out of this trade for a 3 or 4 point loss, and it was a little over $3,000 loss on the setup. My planned risk to reward ratio was about a 5-to-1, and I got out of that trade for a loss. Now, again, like, this is what I mean about repeatability. The same exact day, 3 minutes later, I took the same exact setup. So pulling up Discord here, we can see quick stop out. I was clearly wrong, took the L on it, looking for another opportunity for longs. This can still develop. Even if I'm wrong, it doesn't mean my analysis is wrong and I got to throw it out the window because I just took a loss on it. It may mean that I just simply mistimed the market. And 5 minutes later, I re-entered long essentially at the same price. I even got a better fill this time with the same exact analysis and same exact plan. So same thing here, pulling this chart up. Sells off, breaks the low a day. So exactly what I explained earlier about the market really failing to find sellers under the low, and somebody could be passively buying this. That is validated with this because we got the bounce and the winning trade that I wanted. Broke the low, reclaimed back above with aggressive buying, putting risk on long there, stop loss under the lows, targeting 5200s, which was the high of the intraday session there. And that was a 7-to-1 planned risk to reward. And by the time I sold, I got about a 5-to-1 because I did hold runners. It's the same exact analysis. So earlier when I took that long position, you can see this red line here. That's when I took that long. The market dumped under the low and I stopped out of that trade for an earlier loss. Same thing occurred of why I entered on that first setup. Same thing occurred when I entered on the second one. We broke the low, bids getting filled, aggressive selling, not being met with follow through. The market finds a bid who offers. You can see this orange line right here getting worked. So it was once a bid. Once we broke under it with aggressive selling, it was an offer. Then the market reclaimed above this, and 51.75, where this orange line was, then acted as support. So now, all right, I'm eyeing out an entry here. I'm eyeing out an entry. Market rallies up, pulls back down, and guess what is supported again? Where this orange offer slash bid was, gets supported once, gets supported twice at 51.75, and right then and there, I was like, all right, Carmine, let's put risk on long. Got long as the market was rallying up, stop loss under the 75s, targeting that high of day. So the biggest thing is, all right, 11,000 on this trade. The previous trade was a $3,000 loss. Number one, risk management, and number two, repeatability. Finding the same setups and accepting that you are wrong, taking the loss, and looking for another opportunity because it's all about the repeatability. And to validate this even further, this was Monday, March 11th. The same exact thing happens here. Now, I will say when I take the largest losing days, it usually occurs if the market is trending up or down and I try to fade that move. In this example, I tried the market long at 51.06, 2-point stop loss. So if I were to pull this up here, my planned risk to reward ratio was a 4.6-to-1. Trading this way enables me to get very good entries, which puts me in the position to have solid risk to reward ratios, enabling me to not have to win as many times as possible because the winning trades that I do take are outweighing all the losing trades. So in this example, the market had this little demand zone, sold off into it, saw buyers on the tape, and I was comfortable putting risk on long there for a 2-point stop loss for a 12-point reward. Exited this trade for a loss. 10 minutes later, re-entered the same setup at the demand zone, 50.97, and this trade did not work out on me, and I took a $500 loss on this setup. Now, 5 minutes after that, same exact thing. The market hits the same demand zone, and I get even better confirmation. One last attempt long, 51.02. Same plan, same target, 4-point stop loss, right? Scaling out along the way, waiting for my target to hit, following my plan, and on this setup, I was able to get a $5,300 profit. So yes, the earlier trades, $500 loss, $1,200 loss, right? They were the same exact analysis, off the same exact levels, same exact confirmations. But yes, $1,200 loss, $500 loss. The one winner, $5,300 gain. Letting the winners compound themselves by finding repeatable setups once you have an edge. Having an edge is the most important concept to this, because if you don't have an edge, you're not going to have something that you can repeat on a daily basis. And on top of this, you have to manage your risk. If you cannot obey your risk parameters, then these $500 losses, $1,200 losses are going to be $3,000, $4,000, $5,000 losses. And let's not even look at this at a dollar amount, because I'm trading 10, 15 contracts, right? So I'm trading with larger size for an average trader. So instead of looking at a dollar amount, let's look at our multiple, right? Our multiple is the most important thing, because if you have one contract or a million contracts, it doesn't matter, because our multiple is still going to be the same. It depends on how much you're risking, point-wise, dollar-wise, compared to how much you're going to make point-wise or dollar-wise in a ratio format. So 15 to 1, our multiple this month, still 53% win rate, but you're going to see some of the days, like that Monday trade was a 0.89 R multiple. Wednesday, 0.84 R multiple. So those are the days I got to improve on. Versus I have some days that are 4 R multiple, 3 R multiple, right? So risk to reward ratios are the most important thing once you have that repeatable system. So the last setup that I want to talk about was on Thursday, March 14th. This was a short on the S&P 500. Again, long or short, the setups just you have to flip. When I'm talking about repeatability, like looking for sellers or looking for buyers, and how to actually look for them when you are short-term scalping, because I am short-term scalping and looking for quick, volatile moves in the market. So this trade on Thursday was a 3.2 to 1 planned risk to reward multiple. Because I held runners, I got above my original plan at a 4.3 R multiple. Now, the basis for this setup, and I made a little recap on my Instagram. If you're not following me on my Instagram, I'm going to put a link in the description below to follow me. It's just a good resource. I post like daily trading recaps on here and just tips and tricks you're not going to find anywhere else. But I'll link it in the description below. But on my Instagram, I basically recapped this setup, and it was just a simple one. So the market came into the supply zone, and how I like trading, or what I've found to what I see a lot of the times, is the market, if it's, let's just say, in a supply zone and news is getting released in the near future, it's a good chance. I'm not going to say it happens 100% of the time, because nothing in the market is certain. But it's a good chance, or the probabilities are in my favor, or what I am looking for is if the market is inside of a supply zone, for it to drop when news comes out. Or if the market's in a demand zone, I am expecting it to rally when news gets released. So essentially what happened is we had news at this supply zone, and the news gets released, and the market dumps off of that supply zone. So with this in mind, I'm like, okay, something went off in my head, and I'm like, all right, Carmine, let's now look for possible sellers to step in that we could say, hey, let's use this as context, let's get short, and let's target the support levels below. So before the market even opened, and this is the benefit of trading futures, is I got short at 52.45, expecting more downside continuation. Now, what this looks like on the tape is here we can see some size coming in there. The market retests this off of news at 52.50, 52.49, right? Then we sell off, and there's massive size or massive activity, something strange going on here at the 45s. So with that, I was like, all right, we just rejected a previous level up here. We're seeing some large prints come in. Let me take a stab at this short, because we are rejecting the supply zone, right? We are rejecting the earlier activity that we saw. And my risk is only 4 or 5 points on this setup for a potential 3 to 1 R multiple. So with that in mind, I was like, all right, Carmine, I'm comfortable putting risk on here. Then the market sells off, and we retest where that activity was and rejected it. So now I'm like, all right, this thing really, really is looking good. That if I didn't get short earlier, this could have also provided a solid opportunity to enter short if you may have missed that earlier short off of that. Then the market opens up. Massive absorption happening here at these 40s. Massive, massive trap buyers. And then we get a really large drop to the downside. And this setup, I mean, worked very well. Just rejected it and dropped. It's pretty straightforward. And I held runners, and this was a setup that was just one and done, and that's it. And you call it a day, 30 minutes is the market being open. So if you take one thing out of this video, it's simply build a strategy or build an edge that you can repeat on a daily basis. Now, it's not like sitting here like so rigid and not being able to adapt or bend or flex. It's having a core structure that you could repeat and being able to branch upon that structure depending on different market conditions and depending on the opportunities the market presents, and around that, manage your risk. So if you got any value out of this, I would appreciate just a thumbs up, comment if you have any questions, and drop a like on this video. I will catch you all later. Peace.